Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Ho, ho, ho. Merry Christmas. I'm Texas Claus coming from you from the Texas Hill Country. I just came down from the Southern Rockies in Big Bend National Texas Park, not the national park, the Texas State Park, and I went over to my Hill Country shop because you see everybody thinks that Santa delivers all the toys around the world, but folks, after the Industrial Revolution and the population growth, he had to actually solicit some friends and family. So I'm actually Texas Claus. I'm Santa's second cousin on his mother's side, twice removed. Or is it once removed? I never remember. Anyway, I'm helping him, and I'm going to deliver all the toys to Texas, Oklahoma, Arkansas, and Louisiana, the 4 states area. We'll let New Mexico take care of themselves. They'll be with California and Arizona. Anyway, we're going to get right into it, folks. We're going to go straight into the mailbag and then to the markets because everybody wants to know, are we going to get a Santa Claus rally? I'm going to call. He hadn't called me back yet. I'm asking him, but I hadn't heard back yet. Or are we going to get a lump of coal? Yesterday, man, what a difference a day makes. The Fed came out and rained on the Santa Claus rally. So what's next? But before that, I want to give you a poem that a client and listener sent me because I was doing some of those AI poems. And this is the Night Before Christmas, the Investment Advisor Edition. 'Twas the night before Christmas, and all through the firm, not a spreadsheet was stirring, no data to confirm. The reports were all filed, the portfolios were set, with hopes of next quarter would bring no regret. The clients were nestled all snug in their chairs, dreaming of gains that would ease their affairs. And I at my desk with coffee at hand had just closed my laptop as the holiday planned. When out in the hallway there rose such a clatter, I sprang to my seat to see what was the matter. Away from the door I dashed in a blur with this breaking news or a market transfer. The glow from my monitor lit up the floor as I checked on my dashboard to see what was more. When what to my wondering eyes should appear but a miniature sleigh with an advisor most dear, Revere. With a clipboard in hand and a spreadsheet so thick, I knew in a moment it must be St. Nick, or Texas Claus. More rapid than traders, his recommendations came, and he whistled and shouted and called them by name. Now stocks, now bonds, now ETFs and REITs, on index, on options, on annuities. So sweet. To the top of the market, to the top of the yield, now diversify, balance, protect, and shield. That's Revere. As markets react to swift-moving trends, St. Nick knew the importance of risk that depends. God, this is written for us. So up to the firm's roof, his slate, it did rise, with charts and allocations all analyzed. And then in a twinkling, I heard on the roof the tapping of numbers and portfolio proof. As I opened the door and was turning around, down the chimney, St. Nicholas came with a bound. He was dressed in pinstripes from his head to his shoe, and his tie was bright red, like the S&P grew. A portfolio binder he had flung on his back, and he looked like a broker, prepared to unpack. His eyes, how they twinkled, his dimples, how merry. His charts were precise, his outlook unwary. His droll little mouth was drawn up in a grin as he showed the long-term returns would win. The shine of his shoes reflected with glow of compounding interest that only would grow. Maybe. We spoke not a word, but went straight to the task, reviewing each plan with the question to ask. Are your goals long-term? Is your risk in line? Let's rebalance. I don't like that word. Let's rebalance now to keep things fine. He adjusted the funds, reallocated them with care, ensuring the future returns would be fair. He sprang to his sleigh with a satisfied grin. His work with an advisor, always a win. And I heard him exclaim as he flew out of sight, "Stay invested, my friends. To all, a good night." So, folks, we are going to stay invested. The only question is, what will it be? Cash for defense, or will it be stocks? I'm going to take one drink very quickly. Santa's been traveling very quickly. By the way, you know what? I don't do reindeer. I can't do that. I got to do mule deer down in South Texas. I use a big mule deer. We feed them magic corn. Anyway, now to the mailbag. All right. This is actually sent, and this is very, very apropos for today's show, because this is what we're going to do. How are you going to protect? We've got huge gains this year, or you should. We do. You should. Now, how do you protect them if there's going to give it all back? Anyway, this is from RS, and this guy's an active guy, and he actually sent a quote from a Mario toward this other guy, and basically I'm just going to really paraphrase. Days like today's, we're more inclined to violate our selling rules and more prone to act on emotional burst. I found it helpful to apply and calculate the ADR percentage on my portfolio. This gives me an idea of what my drawdown might be with the selling pressure across the entirety of the portfolio. Now, so with that backdrop, he sent this quote, and then he said, "Hi, Don. I haven't heard you discuss total portfolio ATR in your daily market report, so I thought I'd forward this in case you have an interest. I've started to track the calculation of my growth portfolio. If I am looking at it correctly, always possible, the implied beta per the portfolio ATR calculation is about 3 times the RVAB. Now, one question I would like to add in there real quick, he said, for my growth portfolio. See, here at Revere Growtection, it's growth portfolio when growth is good, when growth is around, and then we get defensive. So you don't have to have a growth portfolio and a value portfolio and a bond portfolio and a commodities portfolio. You can have one all-encompassing portfolio that moves around to those classes. Anyway, so Don said, "Hi, RS. What you're discussing is one of the reasons we created the Revere, Don, what is it again? I always get confused.
Volatility adjusted beta.
Yeah, volatility adjusted beta. We also have Revere value at risk. So we know what the total drawdown is, and we know what the volatility of our portfolio is. Anyway, he created the Revere value at risk portfolio stat, which combines the beta and the ATR and gives us an overall expected volatility and return measure. The excessive volatility in some growth names is also one of the reasons we use the S&P 500 as a minimum 30% foundation for all of our portfolios. It really helps smooth the equity curve on days like this past Monday and Tuesday, this was a while ago, and also yesterday, when growth names get slammed. Beta and volatility are 2 different measures. 2 stocks, this is very important, folks, 2 stocks can have the same beta but drastically different ATRs. The point of your email and post you copied are extremely important concepts, as is position size. Great job in taking the extra step in measuring your risk. Thanks for reaching out." So, folks, what Don's telling you is not only do we have a stop or a measure of risk and where we're going to get stopped out on every single individual portfolio position before we ever buy it. If you don't, you're a retail investor swimming with sharks. And we also have the measure of the total portfolio if it really hit the fan and everything got hit at once. So you got to have that. It's not just about each individual position. It's about the intercorrelation of all the positions with each other. That's an important point. All right. On 12/16 ST, hi, Dan. I heard my story on your podcast and had to laugh. Yes, sir. I listened to your podcast. I was having some of the dreaded year-end tax talks with my accountant and wanted to ask you, since you were a CPA, I do not hold myself out as a CPA. I never paid the license. I passed the exam, got my experience. I just didn't pay the fee to put it on my card. And I'd never practiced as a practicing CPA. So with that said, he said, since you're a CPA, which documents I need to download from Schwab? Is there anything that needs to be added to my info? My concern is as is everyone's, is capital gains. So is there anything I should know to make it more clear? Please advise. He is a conservative money person. Oh, I'm sorry. She's talking about her CPA now. He is a conservative money person and love my neat little Edward Jones style of holding my money. I hated it and am much happier with you and Don. I hope you are doing well, preparing for a happy holiday. ST, you need to download the 2024 year-end Schwab Composite. This will have all the capital gains, interest, and dividends. Yes, CPAs hate when they aren't out of the box cookie cutter numbers. He can just use the totals and include on Schwab's 1099 as supporting documentation. Do not have him itemize every trade. It is completely unnecessary. Folks, if you're a Revere client and your CPA is having you itemize every single trade on your tax return, have him call me. We need to have a discussion. He's overcharging you. Anyway, if you were at Ed Jones, you would probably be somewhere up around 15, 20-ish. Get in a diversified portfolio, worse depending on how much bonds and international you have versus matching the S&P, but with breaks. No, you are correct. It is definitely worth the inconvenience. This is why wealthy investors love K1s, but retail investors hate it. You can pay him with a very small amount of the differential. We made you. Merry Christmas. Okay, 1214 MV. Dan and Don, nice job managing accounts this year. How will you manage risk for big gainers like IBIT, RDD, Reddit, Tesla, ALAB this year at the end of the year for taxable accounts? Thank you. Hi, MV. I see you share my sentiment in keeping taxes low as possible. Properly locking in gains on winners is one of the most important and difficult things about active management. We try to be mechanical about it by employing consistent stop loss system using 8 EMA, 21 EMA, and 50-day simple, combined with offensive profit taking using an ATR extension system. As year-end approaches, we will be weighting these normal systems. These are normal systems or standard systems versus deferring taxes and slightly deviating if needed. What Don means is we'll hedge those positions if they look like they're breaking down for the last week or two into the year and then sell them on January 2nd. So you push the deferral of the gains for a year. If you've only got a week left, you don't, if it's 2 months, you probably need to just take the profits, and because a stock can go down 20% in 2 months if it's a growth stock. And anyway, great question. It will definitely make this.
Can get out in 2 days.
Yeah. I knew that'd get a little reaction out of old Don there. All right. Oh, Don, I love this. So this is a guy from Houston who's been following us judiciously. He came in and was going to be a client earlier, but it was a while ago and we had only 40, 50 million. He was kind of worried we were small. Well, now we're over 200 million, growing very, very rapidly. And he's saying, congratulations, he wants to come on board. He put the world's most accurate pie chart. I think Don has that. He sent that to me and with a smile, with a little emoji, and said, "Merry Christmas, Dan." And me, JK. Merry Christmas, JK, from the professionally managed portfolio team. FYI, our trailing 5-year average of our primary protection, this is about a week ago, is 14.93 net, and year-to-date 31.04 is last night's close. Oh, that was 12.15. Okay, you can't get any timer than that. This is a complete portfolio need for stocks, bonds, commodities, and none of that 60-40 nonsense, because your portfolio adjusts with the markets moving away from weakness and towards strength with no bear markets ever. The main takeaway, JK, is if y'all aren't making at least 10% annualized with no bear markets, you should bite the proverbial bullet you've been talking about and join the Revere family. We are now at 215 million AUM. No more pie charts or us. Merry Christmas and tell AK, that's his lovely wife, I said, hey, Danny. Okay, now, last one.
Dan, AK is your lovely wife, not his lovely wife.
Oh, LK, yeah, AK is very, very low. I'm sorry, I meant LK. Yes, her name is, I'm sorry, I can say her, Lou. Anyway, nobody will know who that is. Anyway, shout out to Lou. Anyway, 1017 TK. Now, this one I like, and you should pay attention to this one, folks. 1217 TK. Dear Don, I hope this email finds you well. I would like to express my gratitude to you and the team for the daily and weekly updates. It has been tremendous for developing my market awareness, not to mention how invaluable the 21/21 stock list is. I am based in Hong Kong and work in fixed income trading. Your updates have been my every morning routine. I cannot have coffee without listening to it again. Again, really appreciate you and your team's efforts. Hope you have a great holiday season. Happy holidays, TK from Hong Kong. That just warms my heart because, folks, think about this. Bonds are traded in multi-million-dollar blocks. If you're a bond trader, generally you work for a big firm that's got stock. I mean, there are some bond-only houses, but generally you're working for a big custodian, a big broker-dealer. That means they got a big equity research firm with 100 analysts or more, right? And this guy's looking at Revere watching our stuff. Is that cool or what? Anyway, Don, thanks, TK. We really appreciate emails like this, as our goal is to educate people on how the markets really work. Me, thank you for the kind words about our team. FYI, we can handle clients in Hong Kong. And when you become a client, the newsletter really comes alive because now you feel in real time what Don is actually saying on the video. And I have signed letters. I have to sign letters every year for a couple of clients who work for broker-dealers somewhere else, and where we say that we make 100% of all the investment decisions. They don't have any input, and we have all discretion. They don't give us any input. That's so they can't try to trade away. That's a compliance issue. All right. Happy holidays. All right. Now, ND, this is the girl that she's a client. She follows us on Twitter too. Great. I got my rub this year. All right. She was one of the ones last year that got the rub taken. We're hoping that it'll make it this year. Folks, all the Revere clients got my dry rub that I make every year. So hopefully UPS doesn't grab yours. If you don't get it, call me though. All right. Lastly, 1216 FC. Please, Dan, please pass on to Team Revere my thanks. You guys have kicked arse this year. And I know no matter what the market does, I can sleep well knowing you are protecting me on the downside. You work hard and it is appreciated. Now, if I can only get the rest of my family on board, I'll continue to work on them. Merry Christmas, FC. Me. FC, this warms my heart and why we do what we do. Merry Christmas. Now, folks, if you've got a system that provides you better returns for less risk, do it. But if you're still in a pie charts or us, where you got a bunch of diversified emerging market stuff and international, there's no international worth owning right now except for Argentina, India, and possibly some Chinese stocks. And that's about it. If you got a diversified emerging markets mutual fund, you've been getting slaughtered and you're still getting slaughtered. Same thing with, on a relative basis. And if you're not getting paid for the extra risk and American markets are doing better, why are you there, right? Why you say in bonds or maybe small cap. Now, small cap may start to heat up, but until now, it's been large cap U.S. stocks have been the place to be. So you want to kind of be there when that's the place to be. And when it's not the place to be, you may want to move somewhere else. But that, to me, is a better way to manage risk than have a whole big basket of stuff that gives you an average mediocre stuff on the way up. But all the correlations grow together and it all goes down together when it goes down. So it doesn't help you. At Revere, we're trying to stay away from the 30 or 40% worst part of the market, focus on the 40% that's the best part of the market when the market's good. And when the market's bad, we'll just try to avoid it or be out or be in short term. So in any event, the market has been on a tear. We've been having a very good run. And then all of a sudden, the Fed came out and they put Powell in front of a microphone. That's always a mistake. And anyway, he started talking and the market started tanking. It actually probably started going down a little earlier, but Don will tell you that. But the whole point is the market really got hammered yesterday. Now we got a little bounce this morning. So what do the tea leaves say and what do the probabilities say? And how are you going to manage making money versus controlling your portfolio drawdown? And with that, Don, I set you up. Don't make me look bad. Oh, look, the world's most accurate pie chart. I love it right there.
That's the only pie chart anybody listen to this wants to get anywhere near. And that what Dan said about international and emerging markets is just, it's 100% true. And you've still got people holding on to this modern portfolio theory, outdated research. What conclusions would they came to? And I'm talking about FAMA and French. If they would have done the research after the big underperformance the last couple of decades from international and emerging markets. They'd have come to a different conclusion. Research has to be updated. The world is different now. United States, the S&P 500 gets a massive percentage of its earnings from global trade, global sales. That decreases, and the lack of innovation over in Europe, especially because of all of the limitations and restrictions that they put on. If you're a tech startup, the first thing you want to do over in Europe is get to the United States so they don't stifle your creativity. It's a pet peeve of mine. It makes no sense. And anybody can say, well, this is what the past shows, is living in the past. If you want to get those returns, you can, but I think we've got a better way, and we show our better way every night on video, 5 nights a week. Ted or Connor do a prep for the upcoming week on Sundays, and we do the podcast, once a week to get all of the team involved in what they're looking at, get you to know every one of us. And Todd, next year we'll start doing the nightly videos as well. We've got a very strong team, and it's a team that recognized, and we discussed on video, the massive divergence that we've seen between the S&P 500, which is what I'm showing right now, versus what was going on and everything else. Yeah, here's the S&P 500 value portion. This completely rolled over starting 3 weeks ago, and as we've been saying, it was just the big NASDAQ stocks. This is the SPYG that had been holding up the market because of their the big tech companies, their massive weight in the S&P 500. Well, yesterday with the Fed, not really a surprise what Powell said, but he mentioned a couple of things. First of all, one of the Fed members dissented and didn't want to cut now, despite the fact that the markets had a 98.6% chance of a cut priced in. So Powell didn't want to roil the markets, but they updated their dot plot, and that changed from their September outlook of 4 cuts in 2025 to 2 cuts in 2025. And then he mentioned additional uncertainty with unemployment, inflation, and tariffs coming in, and how they were going to impact the economy, how it's going to, when you think about it, if you cut, and not to mention the Doge that wants to cut $2 trillion out of the government spending, if you do a massive government spending, that's going to be deflationary to the overall economy. The market hates uncertainty is the bottom line. And all that uncertainty that crept in little by little over the past 2 weeks with the massive divergence in value names took root in a major way, undoing 4 weeks of gains in 2 hours on the market. And you can see there's a reason why we track 3 time frames. Short-term time frame, we broke it yesterday on the S&P 500 and proceeded in the same day to drop 3% and break the 50-day moving average. That's the red line. At the open, we gapped above the 50-day moving average. That failed. So it looks, for now anyway, as if the 50-day moving average has flipped from what was support, if you look back in October where we bounced off it, to the possibility that it's now resistance if we can't get back above and close above today's high in the S&P 500. What we're looking for is something around 59.25 to 35. 35 being the high of the day, 25 being where the 50-day moving average is. The 50-day moving average is not rolled over yet. That's an important point. So that is, if you're looking for green shoots, that would be one of them. That hasn't happened yet. It doesn't mean that it won't. It's just that it takes longer because, well, it's a 50-day moving average. The 21-day has rolled over and broke below the 6,000 level. We've been saying in the videos, as long as you had a 6 handle, there was not a whole lot to worry about. A 6 handle meaning the S&P 500 beginning with a 6,000 level, the 6 handle, the first number being a 6. But we broke that now as well. And a bunch of our stops took us out of the market yesterday. Not only the names that we own, but also our UPRO. We cut SSO, and today we cut UPRO on a third of UPRO. We have different target percentages of how we want to be involved in the S&P 500, depending on what moving averages we're above. It goes from as much as 80 to 100%. And around the 50-day moving average, we want to be between 40 and 60%. So trimmed some of that off. And now when there's emotion in the market the way there is now, we contracted extremely tightly over the past couple of weeks. The average true range of the S&P 500 on a daily basis got below 0.7%, and it's certainly going to be expanding after yesterday's action. So a combination of the expanding range on the S&P 500, the break of the moving averages, stops getting taken out. It's the market telling us something, and you don't ignore when the market is speaking. Unlike pie chart guys that are in all the time that go out dressed the same way regardless of what the weather is. That's my analogy. Do you wear shorts and a tank top in the wintertime? No, you don't. Well, if you're giving off winter is coming type signals in the markets, pay attention to them and put your jacket in your long pants on. It's ridiculous that people don't take the time or continue to insist that the market can't be timed. It's either willful ignorance or unconscious incompetence on their part that they don't want to do anything to learn what's going on, because there are very certain, unmistakably times when you look at the chart and you see that it's not in your favor. And it's just the same as the weather not being in your favor when you're going out, or like I like to say, going to the store and buying rotten vegetables to maintain a balanced diet. It's just ridiculous. You buy what's fresh, you stay in what's fresh, you sell what's spoiling. And in this case, a big change in character in the market yesterday, and we're going to heed that change in character until it changes. Emotions in the market now, so the lines on a chart don't mean as much as when they act as technical support. So we're aware of that as well. And we just pair our exposure and see where the market takes us. There's a time to just be involved mainly in the indexes and setting your stops and sticking to your stops on the leading names. There are some that have absolutely not broken down and are acting well, and we'll talk about 6 of those later. But there are also quite a few that have broke down, and the fellows are going to go through 6 in particular that aren't working. And like I said, Ted did a fantastic job in the video last night, summarizing what we're seeing and what we're doing. And we're going to do it again on this podcast. I'll do it again in tonight's video, and we'll keep doing it every night. Just stick with what we're saying at Revere to stay on the right side of the market.
That's awesome, Don. I'm glad you brought up this. I love that analogy with the vegetables. You don't go buy rotten vegetables just to have a diversified, balanced diet. You only pick good vegetables. You only want to pick good stocks. I don't want bad stocks. That's why I don't like that risk tolerance for the individual. If you're super aggressive, if Tesla's crashing, you shouldn't hold Tesla. It's dumb to hold a crashing stock. I don't care if you're aggressive or not. I don't care if you're conservative or not. If it's a stock is crashing, your risk profile doesn't matter. It should be sold, period. Common sense. That's Revere. We manage risk to the portfolio, the sector, and the stock individually. Don manages the entire portfolio at risk, each sector section of the portfolio, and then each individual position of the portfolio. Is your advisor asking you for a tea time, or does he sound like Don? Go ahead. You were saying something, Don. I didn't mean to interrupt.
Yeah, behavioral finance, Dan. You're an expert on it. And when people
I've made
tell
all
you
the mistakes on it, I had to learn to manage.
Yeah,
my
well, we all
behavioral
have.
finance. Right. That's the whole point. You got to learn to look. There's a whole genre called behavioral finance. Don's bringing up that basically says, why do smart people or rational, logical people make illogical, emotional, dumb decisions based on, when presented with the facts. Now, maybe they're not presented with the facts because they've learned all that modern portfolio theory nonsense that assumes returns are under the bell curve, and they're not. So the whole thing is out the window. But they rely on that. You can't rely on that. Don's right. You got to do the work. This is, like Don said, you don't go to the doctor one time and then set it and forget it. No, you go for regular checkups. You make sure you keep checking on it. Well, your financial health is second only to your medical health, your physical health, right? Mental health. Once you get your health, your financial health is second. We check that every single day. Every day we look in the morning before the market open, and we're like the Zen Buddha of that dollar. We want to pray and meditate. Where's the best position of my dollars going forward? Are they in the best positions? And then, oh, by the way, My portfolio, Don's portfolio, looks exactly like your money, like your That's why we named the show Your Money. Okay? Your portfolio, if you're in Grotection, 100% of Don's, well, he's got a couple portfolios that he's testing that are leveraged and stuff, that he's got little bits of his own money that he's testing because he can't test a new idea on a client portfolio. But the lion's share of all Don's net worth is in Grotection. My net worth is in Grotection. So when Don buys a stock for you and he's buying 3.5%, we're buying it for Don, we're buying it for me, we're buying it for my 92-year-old mother, all at the same price, at the same average timestamp, because if it's a good idea, it's a good idea. If it's a bad idea, it's a bad idea. It doesn't matter if you're 25 or 40 or 80 or 90. If it's a risky stock, they say my 92-year-old mom shouldn't own. Nonsense if you got a sell discipline. If you manage a drawdown, she's not going to have the big loss. So an aggressive stock can be suitable if you know what you're doing, if it's professionally managed, not just in a mutual fund pie chart with emerging market funds. All right, Don, go ahead. Sorry, I had to get on my little rant before Christmas.
Yep, got it. Here's the line. I'll draw a line right now for what we're the main next support level for the S&P 500. It corresponds to like basically 58.50 to 58.78. 58.78 was the high that we experienced in early October before we broke out above the election. When we pulled back in mid-November, we respected that 58.50 to 58.78 level, and 58.67 was yesterday's low. We closed at 58.72. Today's low, 58.83. So this is the next level that we want to hold, because the next range down is another 2.5% to the 100-day or 20-week moving average. And that's another significant move down. You've got another a level of support here going down to the next level that we would have to chew through before we get to the 100-day moving average. But this is the time where we kind of sit on our hands. Certainly don't want to overtrade. If something looks strong, monitor it, but it could be strong and you could go out for a 30-minute walk and come back and the whole market could dump again. There's a lot of emotion in the market right now. We have to let that emotion play out. We have to let new resistance and support levels establish themselves. The market will display what the leaders are on a relative strength basis, and we'll be all over those and discussing them in the nightly videos. But for now, the next level down, 58.50, is the next level that we absolutely need to see supported. So you got another percent or so to the downside on the S&P 500. All the other indexes have broken. The NASDAQ 100 clearly holding up the best, but it looks like the 21-day moving average has flipped to resistance, same way that the 50-day moving average flipped to resistance now on the S&P, right? The 21-day, just because of the big relative strength that we saw in these mega cap tech names over the past 3 weeks. Gave a bunch of that back yesterday, but that's why it's above its moving averages. So that's where we are on the major indexes. Now, the fellas each have two.
How much cash do you have currently? And what?
About 45% cash, and our beta is back down to around a 1, which is where we kind of target when we're battling the S&P 500 on the around the 50-day moving average. We want to target about 1. Because you don't want to dump, you don't want to dump everything. You know, we're going to let our different levels, and we invest over 3 time frames. You know, right now the short term has turned bearish. The medium term is obviously under pressure. The long term 200-day moving average is still quite a ways away. So, and you'll get big gyrations down around that level. The 200-day moving average, we're above it by 7% still. Our balance at risk is around 3%, which means that the individual holdings will get taken out, and the different levels, if we break the 20-week or the 30-week before we get to the 200-day moving average, will just scale out of the market and then look for proper reentries.
And that's the point that I wanted to point out. I wanted to put my Don Terpeter on for the retail non-stock nerd invest. So look, it sounds like we're super active. I mean, we are very active. I'm not saying we're not. But we're not day traders. We're not just trading all the time, and you got to do it in layers. You got to have a short-term layer, a mid-term layer, and a long-term layer, so you're just not getting whipsawed all over the place. And these are mathematical levels. And so Don has taken the growthier, the NASDAQ areas off, and he's left some exposure on the S&P, and we're right around the 50-day moving average. If we hold and move higher, that was right, because our beta is 1. So we have 40% cash. That doesn't mean we're 40% less risky than the market. We're actually right in line with the S&P. So your amount of cash is not the same as the risk of the portfolio or the beta of the portfolio. So right now we're in line with the S&P to see if it holds the 50-day moving average. Don's saying if that breaks, we'll start taking off another layer. If it holds and starts rising, then we can add another layer. And then if NASDAQ also looks good, he might start adding growth stocks. So this is very mechanical. It's very based on levels, not only of the index levels, but the individual stock levels. So this is probabilities at work, not tea times. All right, Don.
Yeah, so in our morning call, setting the agenda for the podcast, each of the guys, we decided, find 2 stocks that are showing relative strength, 2 each that are showing relative strength, and 2 that are broken down. And it just so happens that the 6 that they came up with are the 6 that are remaining in the portfolio. Dan, what is the odds of that? Well, they're 100. Well, they're 100%. But honestly, I didn't tell them. What?
No, that's fine. Well, that's good, Don. That's called confirmation. That's confirmation.
That's what it is. Sometimes confirmation bias is not a bad thing.
Well, anyway. I'm sure some of the ones that broke. Yeah, I'm sure some of the ones that broke down were some of the ones that we got stopped out on. But let's see what they are.
Absolutely.
Yep.
That's the way it goes, though.
So let's go
to let's go to Connor first. 2 winners and 2 that have broken down. Take it away, Connor.
Yep. So start with the first one is Tesla. And just to, when the market starts to pull back, it can be a good thing, because this is going to tell you if the stocks that you own in your portfolio are good or bad. And even if you don't own them either, you still want to look for stocks that are holding up well. And, I feel like mainstream Wall Street sometimes thinks that the market starts to pull back. A lot of new traders think they want to short the strongest stocks because they have a lot of room down, but it's actually quite the opposite. When the market pulls back, you want to find the stocks that are resisting the urge to go down and staying up. And Tesla is acting that way. Yesterday, obviously, it was short-term pretty extended into yesterday, right? It was 8-9 ATR above the 50-day moving average, which is historically pretty extended. And then it obviously pulled back with the market, but it just closed slightly above the 8 EMA. And, when you see things breaking the 50, the 21 EMA, and then you look at Tesla that closed above the 8, that clearly shows that it is showing relative strength. And from a relative performance from that kind of election catalyst when the market gapped up, Tesla's one of the top performing names. And it's pulling back again today, but overall, I think it's very healthy. Let that 21-day catch up. This is just breaking out into new all-time highs, and expectation would be for this one to be supported on dips, as it's just clearing out of a huge base. And, with this 21-day catching up to price, that could provide the rest that it needs if it wants to move higher. So that's Tesla. And then the second one is ALAB, another one that we own in Grotection. And in the semiconductor space, there's a lot of relative weakness, but ALAB's one that really stands out. And again, this closed slightly below the 8 yesterday. And, it's a little bit red today, but it is still building higher lows, and that 21 days finally catching up. So, with the market pulling back a little bit, some of these names that have been in lockout rallies, that first touch to the 21-day or, a left side support can be a good risk reward spot to try something. Because there's been a lot of names in this run that haven't given an opportunity, and now they're finally starting to pull back. So, don't don't buy the laggards. You want to buy the leaders that are pulling back orderly. And these two ones that I just showed, based on price action, the pullback looks pretty normal. I mean, it was slightly above average volume, but you have to take the context in what happened to the market yesterday. And, it was huge volume on the indexes, and especially with growth stocks, you're going to expect, that volume to follow as well. So keep an eye on those. Those are two. Obviously, we own them, and they look great. And then what relative weakness wise, VRT stands out as major relative weakness, and definitely a reason why we sold that in Grotection. And this one just kind of, a rounding top-ish formation and losing the 50-day. And you could see it's kind of got like a head and shoulders top. And then the one tell was when it made highs, that relative strength line quickly came back in, and it gave up that move almost immediately. And now this is breaking that head and shoulders top. And then one thing to just note about this name is this one's been on a huge run for the last 2 years, from low double digits into triple digits. So, probably no one knows if it's topped out, but maybe just needs a longer term base, and that's what stocks do. I mean, Tesla's a perfect example. It was just basing for almost 3 years until you got this run now. So this one, living below the 50-day moving average, we don't really fish in stocks that are trading below that average. And then another one is Lemonade, and this was a super strong one in the recent 2-3 month rally that sparked on a power earnings gap. And this is just not an orderly pullback. After a big move up, there's differences between buying a pullback and buying a knife, and this is just a slow bleed down. No buyers are coming into this one, making lower lows below the 21 days, acting as resistance. So it's just no relative strength here. I mean, now what could change if this could show some volume and reclaim the 21 day, then it would be more actionable, but just continues to drift lower. It seems like it's lost the buyers the last couple of weeks. So that's kind of how I like to think about spotting relative strength and relative weakness if the general market starts to pull back.
Good stuff. And a point about Tesla and ALAB, and we're not always right about this, but it's something that we do internally, is to do offensive selling of names. And we did some of that with Tesla at 460. It went back up above 480 before reversing. Now it's down to 421. Doing some offensive selling, locking in profits, it certainly stings the it dulls the sting of when things pull back harsh on a harsh basis like this. And look for the emotion to come back out. Look for it to stop going down, be supported at a particular level, and then you can buy back what you sold significantly higher. We did that with Tesla. We also did it with ALAB. And we did it on a stock that Ted's going to talk about here in a second too. But look at how this kind of has traded in a channel, and it's a matter of selling the top of the channel, looking when it comes back down to the bottom of the channel, or we like stocks that respect the 8-day exponential moving average. That's the purple line. And then it held it most of the way, finally broke it yesterday and today, but we're down to a quarter size position in this. With our stop at the 21-day moving average now. We put the initial stop at the 8. We want to find things that are riding the 8 in a hot market. When the 21 gets above our cost basis, we raise part of the stop to that 21, and that's where we are now with this last piece of ALAB that we own.
Don, I want to make one point so when Don's talking about this rinse and repeat, so with Tesla after COVID, after the COVID bear bottom, Tesla was was the best performing. It was one of the top 3 leading stocks to own in 2021, and it was one of our biggest positions. We did great with it. In 2022, Tesla was the worst performing stock, and it lost 69% of its value. And we were out obviously because we've got sell rules. And so leading stocks get hammered during their bear market next cycle. So you don't want to hold these best of the best leading stocks during the downturn. And then we got back in Tesla this year. So we've been owning Tesla. It's one of our biggest positions. That's why these growth stocks, when they're good, they're good. When they're bad, they're bad. And that's why, and that's managing risk, because you didn't know with hindsight, you look back and say, wow, Tesla came back. You didn't know that then. So we managed around the Tesla crash. We didn't have to go through it. If you bought and held Tesla, you did. By the way, you also don't compound your money as fast. Okay, Don, sorry.
Yeah, Tesla pulled back in 2022 from 400 to 100. Yep. 75%, which is a little bit above the, the O'Neill says the 72% on average. After leaders top, they will pull back an average of 72%. Some of them never come back. Some of them, like Tesla, do.
Halfway through 2023, I think it was down another 30. When 2023 stocks were rallying and Tesla was getting hammered, it was the worst performing S&P stock the first quarter of 2023. Yeah. I think, Don. I think that's right.
Yep. You can see the relative strength line here while the market is rallying. So,
right.
The market the charts give you all the information that you need to make rational decisions.
But I've got a question for the client, for the listener. I've got a question for you. Just think logically, just common sense. Don't worry about regulatory terms. Don't worry about Wall Street terms, asset allocation. Is it riskier? Do you think it's more risky to hold a stock that's going down, or especially a stock that's going down rapidly, but a stock that's going down versus one that's trending higher? And you're saying, oh, smart. I mean, that's duh. Of course I don't, of course I don't want to do that. But that's what we're talking about measuring. And that's what we're doing versus, pie charts are us. So anyway, all right, who's next, Don?
All right, Todd's next. And he's, again, got two winners, and two that are holding up and or that we own, and two that have fallen by the wayside. Take it away, Todd. We'll start with Broadcom.
All right. Well, actually, my comparison to Broadcom is not really a bad stock. I wanted to kind of take the angle that if we have two stocks that are similar in the same industry, do the same general thing, had recent post-earnings gaps, which one of these stocks is acting better for us versus one that may be showing a little bit more undesirable action. We'll start with AVGO, which had a very strong post-earnings gap, rallied and followed through quickly to a 36% gain from the pivot and has recently backed off. Now, overall, we would look at this as being a normal pullback, still above its 8 and 10-day moving average, and still holding above its earnings gap lows. So in general, it got a little extended in the short run, but it's pulling back and it's still acting normal on this pullback. Now I'm going to compare that with Marvell, which also had a very strong earnings gap. However, there's maybe a couple different ways we could look at this as being perhaps inferior to the way that Broadcom's acting. First of all, we had a very strong earnings gap, but one of the things we don't like to see is it went and filled and dropped below the lows of that earnings gap day. Now, it did redeem itself and go on to make a high and went up very strong. And again, Broadcom's numbers really helped push that into new highs. However, over the last 3 days, actually Tuesday and Wednesday, Tuesday was an abnormally large down day, and we followed through yesterday. And we did not only break the earnings gap low, but we also broke the low intraday, and we closed below the low of the previous low. Now today, it just so happens to be that Marvel's acting a little better than Broadcom. However, it's broken its short-term moving averages, and it's it's a little bit harder to hold. Had we been in two stocks, or we're evaluating two different stocks, this one would have a lot more volatility. And also, Marvel had a 17.25% drop from that high to yesterday's low, where prior to today, AVGO had a 13% drop. So a little more tightness in the AVGO chart. So going on to the next series, we have one of the ones we're long, Google. Now Google broke out of this nice cup with handle on the announcement of their new Willow chip, which is a quantum computing chip. And quantum's been very hot. It's a hot new area that is just blowing up. And some of these stocks have recently gone up several 100% in a few short days. So with that announcement of the Willow chip, Google broke out of this cup with handle, had follow-through day, and is simply pulling back normally to its 8 EMA. So this is a desirable pullback with a very contained pullback despite a very weak day yesterday. And now on to the weaker stock that recently broke down on an intermediate term basis. We're going to look at DoorDash. So DoorDash, after the breakout, if we were in this stock and we were riding this trend, DoorDash has had a very nice uptrend. And I just simply wanted to illustrate how we may exit a position like this if we were long it and we were riding that average up, which is the green line is the 20-day moving average. So this stock has up to this recent break of that 20-day moving average, it's been obeying that on the way up. And on Wednesday, it went on and it made an intraday new high, reversed out those highs, and then yesterday dropped through that 20-day moving average on above average volume. So if we were looking to exit our final position, we would likely use that 20 EMA and that break yesterday as the point to finally get out of our full position. Now, as of now, it's still holding up on its 50-day moving average. But when you have a stock that's been obeying that 20-day all the way up and it has a very sharp volume break to that 50, that is a change of character in the stock's behavior. So this would not necessarily be a situation we would look to hold through based on this change of character.
Absolutely 100% true. And another, you also want to always be monitoring for relative strength. Both Todd and I got upside alerts in Dash on Tuesday because it broke back above this 180 and this 181.83 prior resistance to the left side. But if you look, a real subtle clue, when it did not, relative strength did not confirm, and it reversed later that day. And then yesterday, of course, came completely apart. So and note the higher volume on the selling days. You're seeing red stripes higher than the blue volume days. And yeah, I mean, it's when you see a break like this, very often the stock needs a base now after a nice run up. And this is why William O'Neill had sell rules. Remember, most of his stocks, he suggested taking profits in 20 to 25%. And the special ones, the ones that go up to 20-25% in less than 3 weeks, are the ones to potentially hold for a longer move. But that's a key concept that is really not talked about when you have success in a stock. It's not always easy to just get out with a 20-25% gain. Everybody thinks that this is the one that they're going to hit the grand slam with, and the odds are just not in your favor. So book those profits and move on to something that's continuing to show relative strength.
And what are the
Thanks,
difference in the
Todd.
metrics? What are the difference in the metrics of those two, Don? I'm putting you on the spot here. So, like you're saying, you normally you start taking profits at 25%, but then there's a few special group that have the propensity to really go higher. Is there a way to tell? What's the way to tell, or how do you let those winners run?
It's the 20 to 25% gain in 2 to 3 weeks out of the base breakout are the ones.
Okay, it's a short-term breakout that's the key that separates the true market leaders from just solid growth stocks. That's what Don said.
And we don't often what we do is we're cognizant when we're to that 20 to 25%, but then we just keep raising our stop up with the 8-day moving average,
right,
or the 21-day moving average, and when it finally breaks or starts to show relative weakness, that's when we would exit the position.
Sure.
All right, appreciate it, Todd. Let's go on to Ted now, and shocker, Ted's going to talk about Bitcoin.
Teddy Bull.
Yeah. So the first name that I want to talk about is IBIT Bitcoin. It is starting to weaken up today, but just wanted to emphasize that we still are tracking relative strength. And even though a stock or a crypto or another security shows relative strength for one day, that doesn't mean that it will continue to stay strong. So just monitoring that. Here, Bitcoin is still above the 21 EMA, while the S&P and NASDAQ, obviously Don reviewed that, below their 50-day moving averages and 21 EMAs respectively. So clearly, just even based off relative moving averages, Bitcoin is showing relative strength. And Don drew the upper trend line, the lower upper trend line, as well as the topping resistance line. And that's kind of the channel Bitcoin is trading in. I'm always really not a fan of ascending bases because either they resolve to the upside into accelerated move to the climax, which obviously you would love to see, or they usually, if they break the downside trend line, often can cause a massive shakeout or just massive breakdown that requires a lot more digestion and sideways. If you pull up the weekly chart, you could see that, at least on IBIT, we gapped up because Bitcoin made a move over the weekend into Monday, and we've reversed back into the space. And this is after a pretty big move out of the base breakout. Definitely some signs of Bitcoin being tired, and just overall macro picture with the Fed signaling that there probably will be less rate cuts next year. Since Bitcoin and just equity markets in general are liquidity driven, that adds on to the weakness. This is definitely a change of character, a failed breakout back into the range. There's still a huge air pocket back to the 10-week moving average. So I wouldn't be shocked if we do retrace and test the 10-week. At some point, all these leading crypto names or stocks, as we've talked about many times on the show and in our videos, will have to retest the 50-day at some point in their moves for a potential bigger move in the future. So that's Bitcoin. It's still showing relative strength now. Of course, that could completely dissipate in the coming days. We just look at things real time, and this 21 EMA will be key. And if I can see that properly, it's actually starting to roll over here and at least flatten. So just a few warning signs as well as some relative strength. The second name, actually, before I talk about Reddit, I want to contrast it with MSTR. And we've talked about the significant premium that it's been trading at. And currently, for those that aren't aware, there's an MSTR-tracker.com, and it really just breaks down the premium of MSTR to the Bitcoin they hold. It keeps a real-time tracking of the number of Bitcoins they do hold. And right now, MSTR is trading at a 1.9x premium. So what that means is whatever Bitcoins they own, and right now they own about 350,000 Bitcoin for last time, at least on this tracker. It just means that you're essentially paying near 200,000 per Bitcoin if you're buying MSTR right now. So you can see this is much weaker than Bitcoin itself. Below the 8 and 21 EMAs, you see a lot of sharp reversals. Sometimes we like to call that porcupine characteristics. You can see that exhaustion candle that Connor talked about a while ago on the podcast, using SMCI as an analog. And then you have those that Don just highlighted, gap up reversals. And those are just some signs that this name started getting heavy after its huge momentum move, and now it's starting to roll over. It's almost back to the 50-day. So that's a compare contrast Bitcoin MSTR. Another strong name I wanted to talk about is Reddit, and this continues to act like a champ, still trending above its 21 exponential moving average, even after an enormous 70% plus move after the earnings gap. And it did break that upper trend line that Don drew, but we'll just have to see how it acts against this 150 half Livermore level, as well as the 21 EMA. Really, the bull case here is that they put up their first profitable quarter, I believe, ever. They increased their daily active users, and some believe that their enormous amounts of data can be used to train large language models like ChatGPT, and they could license that data out to various companies. And you can see earnings, triple-digit earnings, double-digit, mid to high double-digit sales growth, and that's usually what sparks new growth stock moves, which is that surprise quarter, especially on an IPO base. And then the next weak name I wanted to talk about is HIMS. Even though HIMS has triple-digit earnings and revenue growth for quite some time, the nature of the stock is extremely whippy. Just various news events regarding their GLP-1 analog drugs. There's some data coming out that actually shrinks the heart and weakens muscle tissue. So it seems like the market's starting to price in some of those potential worries with the GLP-1 drugs. You can see it tried to break above 30 3 days ago, fell back in, followed through, and then today, I believe on some news event, gapped up another 10% plus, and now it's looking to close below the 50-day moving average, which is a huge red sign, and definitely relatively extremely weak. You see that RS line also failed back into, I guess you can call it a base, RS line base, and it's starting to roll over here as well.
Good stuff, Ted. And some subtleties of that. You see this this break green flag here. This is this means that HIMS did make that 20 to 25% move up from the pivot in less than 3 weeks, but you always have to dig in a little bit. This is just a computer program saying where was the price 2 to 3 weeks from the pivot and putting that flag on there. It's not discussing the fact that it actually hit the breakout failure level multiple times after this initial gap higher. And this is what Ted was talking about with how whippy this is. There's a lot of news tied to this, especially with GLP-1, because they're doing their own compounding because the underlying drug is in a short supply. So you can basically make drugs without having FDA approval if there's a shortage by creating your own compounds. And that's what they were doing. They were getting sued because of it. They were having some big success because of it and some big sales growth. But this is unholdable, I guess, is the word that I would say if you're trying to look for something that's going to trend its way higher smoothly along the 8-day exponential moving average, which is kind of what we look for. So yeah, it hit that, but that doesn't blindly mean that you cannot sell this for the next that 8-week hold rule, or you'd give him back everything that you'd have gained. We just don't do that. I mean, that rule is designed for really a very few specific big leading stocks and not for something that's all over the place in its chart like this. Thanks, Ted, and also Connor and Todd. And that is the tech presentation for today's podcast. Dan, Texas Claus.
Texas, there you go. And what Don was showing you, that stock that broken down, it was a nice fresh vegetable when he bought it, but then it became rotten. So what do you do with rotten vegetables? Or rotten fruit? Do you keep it or do you throw it out? You don't want to keep rotten stocks for a balanced portfolio. Remember, folks, price equals truth. If you're arguing with price, you're arguing with truth. And the stock can always go down further. The number one there's a lot of mistakes retail investors make, but one of the biggest mistakes they make is They don't want to admit that's behavioral finance. They don't want to admit they're wrong. I hear it all the time. Oh, I'm just going to wait till that stock gets back even and then I'll sell it. Why? Let me ask you a question. Excuse me. If that stock, once you have a loss, you already have the loss. It doesn't matter if you book it or not. Actually, if you book it, if it's a taxable account, you'll be able to offset future gains. The question is not, should you book the loss? The question is, do you have something? Is that the best stock going forward to own? You already took the hit. It probably should have been sold before you took the hit. That's what we do. But once you take the hit, the question is, now how do I get back even? Is what are the best stocks? I can only have about 6, 8, 10 stocks in my portfolio total, or you should, right? Individual stocks. How are those the best 10? If it's not one of those 10, it should be sold. Do not wait till it gets back even. That's only so you don't have to admit you were wrong. Investing is a hard endeavor. It takes a lot of work. We do that work. We're not asking for a tea time to play golf with you. Folks, listen, Merry Christmas. If you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button, and this podcast will get sent in their inbox every Saturday morning. We record it on Friday morning, though. Today's Thursday. We're doing an early edition this week, Christmas week, but it'll be early. But if you go to YouTube and sign up for YouTube, you'll get it in before the Friday close. Our stock nerds do that. So 2 ways to get our stuff. revereasset.com and hit sign up, by the way, or go to YouTube, Revere Asset, hit subscribe. You can also contact us button. It'll send me an email. You can have a complimentary portfolio review so you don't have rotten stocks. Folks, we will talk to you next. Well, we'll probably have a New Year's before the New Year. We'll probably have one more show. Maybe not. You'll have to tune in and find out on your money.
Not how much you make in the market, it's how much you can keep.